It feels like a movie that plays on repeat every week. Price, inventory, the Fed, the Trump administration. Everything seems set up so that the housing sector is right in the eye of the storm. The second half of the year is going to be decisive. Why? Because interest rates are starting to flirt with going down, but it doesn't seem like that's going to last forever. It looks like these are very specific moves triggered by a report that comes out, then another report comes out and pushes them back up. All those changes are part of everyday conversation. The Federal Reserve met this week, nothing happened. Additionally, inventories keep rising and it seems like price drops are coming. But where exactly are those price drops happening? Because it seems like they're not widespread. There are more complex situations than ever before in the history of housing. Why? Because we're not facing a crisis, but we're not in a normal situation either. We're dealing with a housing scenario we've never experienced before. Some people can, others can't. There are obstacles. What's going to end up happening? We have to get to the point where we review what's happening week by week. As always, we invite you to keep tuning into our podcasts, because every week we try to examine each of these details as closely as possible to bring you that reality, an honest reality, so you can draw your own conclusions depending on the area where you live, since every area behaves differently. We, as the best real estate agents working in Florida, are going to give you the information we handle week by week, but it's your responsibility to know what to do with it or to consult us directly so we can help you reach the point of making that decision with the least amount of risk. As always, myself, Gabriel Perozzo, am here with my friend and partner,
YENITZE Molina. It's a pleasure to be with you all. And Gabby, I don't know if you want me to go ahead and continue or keep going with what you were saying, but honestly, it's a new setup. And since it's a new setup, both the prices and inventory, as well as the overall market movement, because honestly, the aftermath of the pandemic and the current political situation are new for everyone, and people's behavior is different. And you can see that in the economic activity and also in the housing market movement. Bringing this up, I have an article for you that talks about the prices of new homes and used homes. On a national level, we've discussed this topic on local podcasts because it's something we've been seeing for a while here in Miami, but now it's happening nationwide. And what do I mean by that? We're seeing that existing homes are now more expensive than new homes on a national average. If we look at the years from 2010 to 2019, as the article tells us, there was a price gap of about $66,000 between the two, with new homes being much more expensive. Today, it's the other way around. What's going on? In the second quarter of 2025, the price of a new single-family home was $410,800, which is $18,600 less than the price of existing homes, which stands at $429,000. This means I have an existing home priced higher than a new home. That wasn't the case before. Here in the graph, we can see how they've behaved since 2007. New homes, red line. Existing homes, blue line. And we can see that at the national level, the lines have already crossed. Why? Why is this happening? Here as well, in this other chart I'm going to show you, it's the decrease in prices, the price increase in red as well, new and existing homes in blue. And we can see that since 2023, in the first quarter of 2023, we see how here existing home prices dropped. Then in the next quarter, both existing and new homes did. And after that, the prices of new homes kept dropping while the prices of existing homes started to rise. Reasons. There are multiple reasons. However, I'll say it again, this depends on where you are. That's how these prices move. But on a national level, we still have a housing shortage in the most densely populated areas of each city. When there's a housing shortage, which is basically the inventory, you could say, of used properties, if there's a shortage, the ones that do come on the market just keep going up in price. That's normal, supply and demand. New homes are being built on the outskirts of the cities, which makes it harder for people to go there. So maybe they'd rather stay in the city center and pay a bit more, or keep renting in the city center instead of having such a long commute. That means new homes have less demand. Plus, this is changing. The inventory of secondhand units is coming onto the market. When these used units start coming onto the market, little by little and at the levels we're seeing, more in some cities, less in others, people make decisions, and many prefer to be close to work, prefer to be near the city center for convenience. So if we add to this the sellers of Ho, the developers have to come up with a strategy to maintain their sales, and this is directly reflected in the drop in prices. On the other hand, I have an article from Redfin that talks about prices. Home prices are falling in 14 major metropolitan areas in the United States. Where are these metropolitan areas located? We have 2 in Florida and 2 in Texas. Also, the first one leading the list is Oakland in California, which recorded a drop of 6.8%. West Palm, 4.9, Jacksonville, 3.1, Austin, 2.9, and Houston, 2.8. Let's get back to the point. We have economic uncertainty. It's no secret that there's a lack of affordability. Many more homes are coming onto the market, but because the interest rates just aren't coming down, well, simply due to supply and demand, prices are dropping. I also have the monthly payment. The monthly payment is at $2,671 this week, which is the lowest level since January. All of this is because interest rates have dropped a bit and prices have only increased by about 2% year over year on a national average. Another piece of news or important fact from this article is that pending home sales have dropped by 1.4% compared to last year, while total inventory is up by 8.9%. That translates to a lot more units for you to choose from. People who have the ability and the willingness to buy nowadays have a lot more to choose from. And wrapping up the price section, I want to bring you a forecast from Zillow. Every month, we bring you Zillow's updated forecasts, and today, on July 21st, they published an article saying that 2025 will end 2% below the initial value of the year. In other words, they are increasing the forecast for the drop in prices. As we've said, it's always by area. Here we have a chart where we see, for example, Miami at minus 0.7. Here we have New York at minus 0.5. We have Houston at minus 2.4, and we see that basically there isn't any at the national level. There are very few blue dots. Really, most are yellow and red, which indicate either a slight decrease or, in the case of the redder points, this thermometer shows a greater decrease. They paint the whole country with price declines. And I want to emphasize to you all, if there is a price drop after an increase of about 40 or 50%, it's not the end of the world. It's a stabilization. As Gabriel said, it's simply a restructuring of how everything is going to work.
Yes, Jenny, although the Fed is the main factor in all of this, it has dominated the news. At the end of this podcast, we're going to be analyzing what's happening with interest rates, but that drop in prices will be directly tied to the amount of inventory entering the market in relation to interest rates. If we manage to get lower interest rates, that inventory will be absorbed and we'll see prices either stabilize or start to rise slightly again. So I don't fully agree with that Zillow forecast, because even people like Goldman Sachs are talking about as many as 6 Federal Reserve rate cuts in the next 24 months. We'll have to see what happens with this. However, let's get into inventory, which is a hot topic, because inventory is what will allow us to understand how we're going to enter this new phase of the economy or this new stage where interest rates might come down. It's being said that 2 states have once again surpassed pre-pandemic housing inventory levels. We're at 25% more inventory year over year, but we're still 11% below pre-pandemic levels. Here's the chart showing how inventory has been rising, but we still haven't reached the levels from 2017, 2018, and 2019. We're right in the middle of this curve at the moment. If we look at the numbers, we can see that in 2017 was the time when we had the most inventory since realtors started keeping these records. We were talking about 1,322,000 housing units. July 2025, 1,102,000. So, we're 200,000 units below that. Inventory is rising, but not to critical levels. If we keep looking, we can see it on a map chart. Here we can see how inventory has increased from July 2019 to July 2025, and we see that most states are already above pre-pandemic levels. We see states that are of interest to us as Hispanics. Texas has gone up 24% year over year, 32% since 2019. We see California is still in the negative. Florida has gone up 29% and Arizona has also increased. What's happening in the Sun Belt? Basically, the states that most influence what's called the Sun Belt, or the Sun Belt, are Texas and Florida. That's why we see, as you mentioned, very specific price drops in the main cities of Florida and Texas. Because of that increase in inventory, more room for negotiation, and more sellers, they have to start lowering prices, not to the levels of the big peak or what it was before the pandemic. We have to see where it's lower than the big peak of 2022 or where it's lower than during the pandemic. There are very, very few cases where we're below the pre-pandemic level. If we look at year-over-year growth, we'll see that yes, all the states have grown year over year, although here we haven't reached the levels we had before 2019. The year-over-year numbers are showing us that we're indeed in the positive, and it's a positive trend that keeps accelerating. We see some really striking cases like Nevada, where we have an increase of 53%. However, even with a 53% increase in 1 year, it still hasn't reached 2019 levels. California, which we saw in the negative before, but here we see it growing 36% in the last year. This is where we have to ask ourselves how inventory works in relation to price. Are prices going to go down? With so much inventory, are prices going to drop or not? This is a rent analysis, but it's an analysis that perfectly shows us in this chart what the inventory-price relationship is. In this chart, we can see the effective year-over-year change in rents in terms of price, and this is the year-over-year change in inventory as of June 2025. And it shows the 150 main cities in the United States. The more lines, the more points we see over here, it means inventory has grown. The red line indicates 0, meaning that the price hasn't grown. What happens? Here we can see that with a greater increase in inventory, all the points stay on the negative side of prices. In other words, rents that aren't going up, rents that are going down. We see important points like Austin, Texas. Let's make this a bit bigger here. Austin, Texas. We see Nashville. We see Dallas. We see Orlando. We see Atlanta, Denver, Sarasota, Wilmington, Charlotte. We can see Savannah in Georgia. We can see Lakeland in Florida, which remain at that point. Look at this, a lot of inventory, prices going down. But when we look at where the largest number of points are concentrated, it's where we have less inventory coming in, and indeed, prices are going up. So that's the big connection in how it affects things. We see a single case, which is Boise, where inventory increased and yet, prices still went up. We'd have to take a closer look at what's actually happening in Boise. We see Miami here, and Tampa here, where we have inventory growth of around 2% and price increases of up to 8%, like in Portland or San Francisco. Notice how important the inventory is and how it impacts prices. Finally, to wrap up this analysis, many people say, but inventory should make prices drop immediately. That's a crash. That's what I see on YouTube, and that's what people are predicting. This chart shows us something much more important. This chart shows us the relationship between the population size of the United States and the inventory of homes for sale. Historically, what we need to do is divide the number of homes for sale by the population of the United States, and that gives us a factor. The historical average factor from 1982 to 2025 has been 0.91. In other words, that's the population to inventory for sale ratio. Here we can see that as of 2025, we have 1,400,000 homes for sale, plus we have 502,000 new homes as well that are or could be sold, even if they're not all finished, and we divide that by the 341 million people, and we get 0.58. In other words, we're well below the historical average. Obviously, this varies from area to area. Why? Because there may be some areas where there is a lot of inventory for the size of the population, and there may be areas where there are a lot of people but very little inventory. But in fact, here we see the 2008 crisis. how we were at 1.48. That is, there was way too much inventory for the population for sale, and right now we see very little inventory for sale compared to the size of the population. Those hard, pure, straightforward graphs are what make us see that, in fact, a crash is not coming. Don't believe the nonsense people are usually telling you on social media, where just because one house drops and they show a Zillow stat, they'll try to tell you that's a total collapse of what's happening in the market. These are the graphs we dare to share, graphs that come from the census, that tell us, as the best agents in Florida right now, that this is the information that matters, and that's what you should base your decisions on. Never hesitate, whenever you have a question, send us a text or give us a call, because that could make the difference between making a bad decision and making a good one. Remember, our advice won't cost you anything emotionally, so you can really understand what's happening in the market. Jenny,
What?
all of this ultimately translates into sales. So, how are home sales doing? Because there's a lot of inventory, prices are high, but are homes still selling?
Yes, let me tell you, sales are happening, they're being managed, but I wanted to say all these numbers Gabriel just mentioned, plus what I'm about to explain about sales, have one thing in common. It's not an absolute figure, it's not. It applies to everyone and to every area. It changes. Honestly, I encourage everyone to work with a real estate agent. We're the best. We're here in Florida, and we can help you. But if you're not in Florida, find a real estate agent who can be by your side, because it's not absolute. There's a lot of inventory. Okay, perfect. So I'm going to make a low offer, but maybe there isn't that much inventory for the type of property you want to buy, and as a result, you'll be entering the market the wrong way if you only look at the big number and don't pay attention to the details. That's why I want to talk to you about this Redfin article, which discusses sales of starting homes, what we call entry-level homes, which increased by 4% in June. And this is what you usually do as a real estate agent. I come straight here to the table, and you see that the inventory is segmented by price. And you look at the prices to see what units I have available, how the prices are moving, and how I need to act, whether I should sell or buy. And in this case, at the national level, I have the entry-level homes, the ones with an average sale price of $260,000, which increased by 3.1% in price. Sales went up by 3.9%, and pending sales increased by 3.1%, and active listings also rose by 19%. These are the most affordable homes. Their prices keep going up, and pending sales keep increasing as well. It's not a market that's on fire. It's not super hot, but it's also not a market where you can come in with lowball offers, with really low offers. You can't do that because it's a market that's moving. And here, they also show us how prices are moving. The mid-priced units are at $370,000, and the high-priced ones are at $577,000. We have a small increase in prices. We have a decrease in the number of homes sold. I have a decrease in pending homes and an increase in inventory. My behavior is completely different. And in a luxury market, I have an increase in price, but I also have a decrease in homes sold and pending homes and an increase in inventory. Depending on where you're going to buy or sell, your strategy needs to match in order to succeed in the transaction. Additionally, we're going to compare new home sales and existing home sales, and I have these two charts to show you. Existing homes have seen a decrease in sales of 4.85%. And what has happened with new homes? They have experienced a decrease of 21.33%. This article is from July 23rd, 2025, and the data goes up to April. We have April 25th. So what does this mean? It means this is also the reason why the pre-construction developers are doing what they're doing, which I mentioned in my first comment on the poster, which is lowering prices. Because they need to keep up or not lose the ground they had gained here. They need to try to maintain their share of the market. What share did they have? Here we have new home sales as a percentage of total home sales. They're currently at 11.75, and in 23 they had 15.82. They have lost a considerable share of national sales, and that, of course, directly affects their profits, their stock value, and the earnings of their shareholders, which is who they ultimately answer to. Now, all of this is obviously related to interest rates, and I know you, Gabriel, have a lot of information about interest rates for us. Of course.
Yes. Before we get into the interesting part to see how extraordinarily beautiful it is, it's been over a year since we've seen it look this good. I want to touch on something important because we got a question this week through the RedX network on Twitter, and it's worth clarifying what new construction actually means, Jenny. Why does spending $1 to lower mortgage rates by builders generate more savings on payments right now than reducing the price by $1? Someone asked me why, instead of helping with the rate, builders don't help with the prices. Because in the end, what people believe is that the builder doesn't want it to look like they're lowering prices, so they help you with everything else before lowering the price. It's not about what they want or don't want people to see. It's about what helps you, what helps the bank, and what helps the builder. Obviously, the builder doesn't want to see their product go from being worth $500,000 to $450,000. They want to keep the price up. As a buyer, you want your monthly payment to be lower, regardless of the actual price. You don't care if they're selling you a house for $500,000 or $470,000, as long as your monthly payment fits what you need to pay. So in the end, you just say, I have to pay this amount. If they tell you the payment is the same whether it's 470 or 500, sometimes you don't even notice. It's like with a car, you don't know how much it's costing you. You know how much you pay for it each month. It's very similar with a house, but there's something behind all of this, the banks. I'll put it on the screen in case anyone wants to read the exact technical explanation, but here's the gist of it. Banks take the loans and resell them. So the moment you sign your mortgage, that mortgage is sold and enters a secondary market that competes with the 10-year Treasury bond market. That's why the 10-year Treasury bond is so closely tied to loans, to the mortgage interest rates. But what happens when an investor comes along and is deciding whether to buy a bond or a bundle of mortgages? They want this to generate dividends for them for as long as possible. In other words, if I buy a bond with a coupon at 4.25, I already know that over 10 years, that's going to yield me 4.25 and the government will pay me. But when I buy a mortgage, I know that's going to yield me 6.50 or the average of the rates inside that bundle. And that's what I'll get over 30 years. But what happens when the rates inside that bundle are very high? People prepay. Obviously, if today you get a mortgage at 6.5 and tomorrow interest rates drop to 5%, you're going to want to get out of that mortgage or refinance it. And when you pay off the mortgage or refinance it, the investor loses the chance to collect over those 30 years, and the bank loses that value because the mortgage was paid off and the interest wasn't collected. So, what does that mean in the end? It means that when the builder lowers the rate for you and says, I'm going to take $10,000 from the purchase and give it to the bank to buy down the interest rate. Instead of giving you a 6.5% rate, I'll give it to you at 4.5. That loan is now much more attractive to the investor because over time, it's much more likely that with your 4.5% loan, you'll stay for 10, 15, or even 20 years since you won't have as many options to refinance and you'll be happy with what you're paying. So banks prefer this and want developers to prepay a certain interest rate so that over the life of the loan, you stay longer. It's an explanation that might be a bit technical, but it benefits you. That's why we, as real estate agents who are in the market, want you to know the reason behind it in a transparent way. Don't just go along because someone danced on Instagram or because someone is saying, don't worry, Inara is giving away rates because it's going bankrupt. No, it's not going bankrupt. There's a whole economic and technical explanation for what's happening, and you need to know it. And it's our duty to explain it to you. So let's look at what happened with the interest rates. Jenny, this beauty, 663. Why do I call it a beauty? Because in just one day, it dropped by 0.12. That's something you rarely see. If we look at the chart here, we can see that from 681, where it started at the beginning of the week, it went down to 675, 675, and ended at 663. It's following an interesting downward trend. What happened? What happened? The labor reports came out. Those labor reports indicated that we were indeed seeing a slowdown in the labor sector. 73,000 jobs were created. What was expected was 141,000. But in addition, they revised down by 258,000 the jobs created in May and June, basically saying, oops, we made a mistake. Not that many jobs were actually created. There are 258,000 fewer under the Trump administration. And Trump directly complained to the statistics office and said, I'm going to fire whoever is in charge of the statistics office because it's not possible for them to make so many mistakes. It's not possible that before last year's November elections, the mistakes were in Biden's favor, and now the mistakes are happening in the context of a weakened labor market. There's a whole political game behind this because even though Trump benefits from the fact that the market is slowing down from an economic standpoint, since this has an impact, it affects the issue of low rates. He's hurt from a political standpoint because politically it looks like his entire economic strategy is failing, jobs aren't being created, and people are saying, we're suffering. However, this is reflected in the fact that the Fed, the central bank, is now much more likely to start lowering rates in September. And there's a very important point, Jenny, that hasn't been mentioned in the general news, which is the specific news. The construction sector was affected in this latest report. And as soon as the construction sector starts to see a drop in the number of jobs, a recession or a downturn in the economy can follow directly. Another very important point. Let me see if I have it here, because I think I took it out. Unfortunately, I don't have it on hand. Another crucial point is that if we were to look at the number of people currently in the active workforce and extrapolate that, what does that mean? There is a certain number of people who are economically active, or in other words, who are working. This number is decreasing, and it's going down for two main reasons. The population is aging. In other words, there are more elderly people than young people, so more people are leaving the workforce than entering it, and because of migration issues. With all the migration restrictions, a large portion of the workforce has been lost. So we have a much smaller workforce. And that means that when jobs are lost, unemployment doesn't rise as much because the base for calculation is smaller and not as large. And the statistics tell us that if the workforce were at its normal size, we would be at 4.9% unemployment, when in reality, we're at 4.2%. So that's also a statistic that isn't working in our favor, but the Fed is definitely paying attention to it. They really do pay attention to all of this. So we're definitely going to see the Fed cutting benchmark rates in September. Goldman Sachs has even talked about up to 6 rate cuts in the next 24 months. Rates are expected to be between 6 and 5.5% by 2026. At any moment, we're going to see everyone changing those forecasts. I highlighted this article for you because it says the growing number of market participants, 88% of the major banking players in the United States, are already saying that in September there will be a 25 basis point cut, according to the Fed Watch. We're at a critical moment for the US economy. Trump is finishing up negotiating all the trade agreements. Some trade agreements are favorable, others are not. Overall, we're seeing record tariff revenue. This is helping the economy. It seems like the labor sector is being affected, but it's unclear whether that's because of the tariffs or because high interest rates are making it expensive for companies to take on debt. A lot to look into. Check it out on the podcast on Tuesday, where we're going to analyze exactly how Trump's economic policies are affecting the housing market. Jenny, analysis. Good news with those slightly lower rates. How wrap up the podcast?
Look, there's a popular saying, when the river is turbulent, fishermen profit. We really haven't stopped having turbulent waters, and depending on where the economy and the market move, that's your strategy. These days, I've seen some really, really good deals being made. I've been involved in deals where we've managed to get very good discounts, and it makes sense because there are a lot of units on the market that have been there for a while, and people, depending on their situation, need to sell, and you can take advantage of that opportunity. Contact us. We're located in South Florida. We have a ton of information for you, numbers, statistics, recommendations, and we provide everything with solid support so you can invest with confidence, knowing you're making the right decision. And it's easy to reach us. Below, you'll find the direct link to our WhatsApp.
That's right. Thank you so much to everyone who watches us. Don't forget to give us a thumbs up. It lets the platform know this is quality content that should be shared. Share it if you know someone who might be interested. And of course, subscribe to our channel, where we have 4 podcasts a week with the best of Florida, narrated by us, the best real estate agents, the top real estate team in Florida. Thank you all so much once again. Where to Live and Miami podcast is a production of Inviert and Miami Real Estate. Total transparency.